Still a bit disappointing. I think China really continues to balance the need for stronger growth. Disappointing recovery thus far from that zero COVID policy through into late last year, but restrained by that elevated debt level. Certainly, local governments dealing with a high debt level are restrained now. China, the federal government, the central government, certainly keeping a watchful eye on that debt level. And then we have those structural problems in the property sector that are really muting the impact of any stimulus, and it has been very guarded so far. And then on top of that, of course, the past regulatory policies that were introduced by the government. Put it all together, and there are some headwinds, we think, to stronger growth in China.
You know, the other thing we've been noticing is there's been noticeable increase in appetite, foreign appetite for Chinese government bonds. Is that something that we should be paying attention to?
Well, I think so. China, apart from most countries in the world, never really went through that big run-up of inflation. Inflation remains subdued. And for that reason, I think Chinese bonds, government bonds, tend to look that much more attractive to foreign investors against the backdrop of a weakening yuan. They have to be a bit more guarded. But with inflation down and not really showing any sign in a disappointing recovery of really flaring up a bit, those government bonds begin to look a bit more attractive.